You might be thinking that your business is growing every day, right? Every month you see a positive jump in the numbers. But does this mean that your balance sheet or profit and loss account is becoming healthier? In this video, I'm going to be talking about the importance of the financial statements for a business and also on how you can read and understand them, which will enable you to improve the profitability of the company. So watch this video to understand how this information can help you accelerate growth. I'm Yashwant Nijgal, a chartered accountant in practice. Every week, I post one video which will certainly provide you with valuable financial insights. Many of the business owners or entrepreneurs think that the increase in revenue means that there is an increase in the net profitability, which is not the case most of the time. So understanding the different parameters of the profit and loss account and acting accordingly will definitely help you translate the increase in revenue to increase in profitability. It is best for businesses to track the profit and loss account on a month-on-month basis rather than on an annual basis, so that any corrective actions can be taken on a real-time basis. The profit and loss account starts with the revenue, and then you have the direct expenses. The difference of the two will be considered as gross profit. Now, having a consistent gross profit is very important. If there is a variation in the gross profit, it either means that there is additional discounts which is being given, or that there is something wrong with respect to the direct expenses associated with the sale. So you should be able to justify the differences in the gross profit on a monthly basis, and if there is something unexplainable, you can act on it and ensure that it is sorted. So after the gross profit, you have your indirect expenses. Now indirect expenses can be divided into two parts. One is your fixed expenses. The other one is your variable expenses. Now, the importance of fixed expenses is that you can define or arrive at your break-even point or break-even sales based on your fixed expenses. This would include your salaries and wages, your rent, your electricity bill, your office expenses, your staff welfare expenses. For example, say your gross profit is 25% and the fixed expenses is 1 lakh rupees per month. It means that if you have to achieve break-even in profitability, you should at least have 4 lakhs of revenue so that the fixed cost can be covered. Finally, gross profit less indirect expenses results in net profitability, and it is also important for us to track the net profitability on a monthly basis. There could be instances where some of the indirect expenses which are variable in nature could be increasing on a month-on-month basis, though there is not an increase in the revenue. So if you have to control the expenses and ensure that the profitability increases in line with the revenue, you need to ensure that these expenses are kept in track. And this will be possible only if you are able to prepare a profit and loss account or an MIS on a monthly basis. Next, we go to the balance sheet, and the most critical part of analyzing or assessing the different parts of the balance sheet is to understand the working capital requirements of a company. The most common challenge that my clients face on a regular basis is the working capital crunch. On the one hand, your sales are increasing, and on the other hand, your profitability is increasing, yet they end up having cash flow crunches most of the time. And the biggest reason is they don't pay enough heed to the health of the balance sheet of the business. In the balance sheet, you have your standard capital account, your loans, and your current liabilities on the liability section, and you have your fixed assets and your current assets on the asset section. What is most important for a business to understand is the current assets and the current liabilities, which will have the biggest bearing on the working capital requirement of the company. Let me explain this with a simple example. Say the revenue of your company is 1 crore in the first month, and you're giving a 30-day credit period to all your customers. It means that once you make the sale, you need 1 month time to recover this 1 crore from your customers. On the other hand, when it comes to purchases, if you have to pay in advance for all your expenses and purchases, this would mean that at any given point in time, you need to have at least 1 crore in your bank account to fulfill the order of 1 crore rupees. And say in the next month, if your sales goes up to 5 crores, and at the same time your credit period to your customers increases to 2 months or 60 days, this would mean that your working capital requirement has increased to 10 crores, which is 10 times of the working capital requirement which was there in the first month. So though there is only 5x growth in the revenue, there is 10x growth in the working capital requirement. And if you're able to track these aspects of your balance sheet, you will be able to understand the exact requirement of funds for your business and better plan your finances. Though the preparation of financial statements, which is the balance sheet and profit and loss account, is mandated as per the statutory compliances, for businesses, it would be best if they're able to prepare this in the form of an MIS on a monthly basis and understand their business better, not only in terms of growth of revenue, but also in terms of working capital requirement and growth in profitability. No tricks, no hacks. Follow me for valuable financial insights.